Good morning and welcome to TOI Japan Market Radio for March 28, 2026. I'm your host speaking to you from Tokyo. This is your daily briefing on Japanese equities, the yen, and rates, designed for global investors tracking Japan exposure. Joining me today is our portfolio manager who follows Japan macro closely. Thanks for being here.
Thanks for having me. So today the Japanese market was actually closed for a public holiday, which means we didn't see any trading in the Nikkei 225 or TOPIX. No updates on domestic price action, but that doesn't mean the news flow stopped. In fact, we've had some significant developments overnight that will likely influence how Japan opens next week.
Exactly. And those developments center largely on geopolitics and energy markets. Let's start with the oil story. We've seen crude prices pull back to around the $100 per barrel level, and the driver appears to be renewed optimism around US-Iran diplomatic negotiations. Can you walk us through what this means for Japan specifically?
Sure. So the headline here is that the prospect of talks between Washington and Tehran has reduced the geopolitical risk premium embedded in oil prices. That's brought crude down from higher levels, and equity markets globally have taken a bit of a pause as investors reassess their positioning. For Japan, this is particularly important because Japan is a major net energy importer. The country relies heavily on imported crude for fuel and petrochemical feedstocks. So when oil prices decline, that typically translates into lower input costs for manufacturers and reduced energy expenses for consumers. It's a structural positive for the Japanese economy over the medium term.
But you mentioned equity markets dipping in the near term. How do we square that with the longer-term benefit?
Great question. In the short run, the dip reflects a rotation out of energy and defensive sectors as the risk premium unwinds. Japanese equities, particularly the Nikkei and TOPIX, could see some modest negative pressure initially just from the global risk-off tone. But if you look through that, lower energy costs should support corporate margins, especially for consumer discretionary names and industrials with heavy energy usage. On the flip side, energy-related exporters, think oil refiners and petrochemical makers, might face some headwinds as their revenue outlook adjusts. So it's a mixed picture depending on sector.
And what about the yen and Japanese government bond yields?
On the currency side, softer oil prices typically put modest downward pressure on the yen. Lower commodity prices reduce safe haven demand for the currency. That said, if global risk sentiment weakens more broadly, we could still see yen appreciation despite the oil move, because the yen tends to strengthen during periods of risk aversion. As for JGB yields, I'd expect them to stay stable or drift slightly lower, especially if global rate cut expectations pick up on the back of reduced inflation pressure from cheaper oil. The BOJ is unlikely to change course immediately, but lower yields would be consistent with that macro backdrop.
Staying with the geopolitical theme, there's been a much darker development that's rattling global markets. Reports are circulating about a major conflict involving Iran that's triggered a massive sell-off worldwide. We're talking about roughly $11.5 trillion in market capitalization losses across global equity indices. This is obviously a huge risk event. How should investors think about Japan's exposure here?
This is a very serious situation. A conflict of this scale in the Middle East directly threatens Japan's energy security. Remember, Japan imports somewhere between 85% and 90% of its crude oil needs, and a significant portion of that comes from the Middle East. Any disruption to supply lines or a spike in energy costs hits Japan hard, both on the inflation front and through corporate margin compression. Beyond energy, a $11.5 trillion global market loss signals deep concerns about a potential recession, which would weaken demand for Japanese exports like autos, semiconductors, and industrial machinery.
So the impact on Japanese equities would be substantially negative.
Exactly. The Nikkei 225 and TOPIX are both likely to face downward pressure from multiple channels. First, export-sensitive sectors, especially automotive and electronics, would suffer from demand destruction as global growth slows. Second, energy-intensive manufacturers face higher input costs if oil spikes further. And third, the broader risk-off environment would compress valuations across the board. It's a challenging setup for Japanese equities in the near term.
What about the yen in this scenario?
The yen would almost certainly strengthen. In a major geopolitical shock like this, investors flee to safe haven assets, and the yen is one of the top destinations for that flow. Now, a stronger yen does help importers and reduces inflation by lowering the cost of energy and other imports. But it also erodes the competitiveness of Japanese exporters, which is a problem for companies that are already dealing with weaker global demand. If the yen strengthens sharply, the BOJ might need to reconsider its policy stance, though any intervention or adjustment would depend on how sustained the move is.
And yields?
JGB yields should decline as the flight to safety bid extends into Japanese government bonds. We'd likely see the long end of the curve rally, pushing yields lower and flattening the curve overall. That's consistent with recession fears and a risk-off environment. In some ways, lower yields provide a bit of relief for the government's debt servicing costs, but they also signal a weaker growth outlook, which is a concern for policymakers.
Meanwhile, in corporate news, there was a notable move in Sumitomo Rubber Industries, which posted a strong intraday surge of 5.09% on March 28, hitting a day high. This is a sizable single-day gain for a large-cap industrial name. What's driving that?
The article we saw didn't provide a lot of detail on the specific catalyst, but a 5.09% intraday rally in a stock like Sumitomo Rubber is significant. This is a major player in Japan's automotive supply chain, particularly in tire production, which is a core part of the country's export-dependent manufacturing sector. A move like this could reflect anything from a positive earnings surprise, a new contract win, or broader optimism about global demand for autos and industrials. Without more granular detail, it's hard to pin down the exact driver, but the momentum itself is noteworthy.
How does a move like this affect the broader market?
For the Nikkei and Topix, a 5% gain in a large-cap constituent provides some support, especially to the automotive and industrial subsectors. If the move is driven by fundamentals rather than a one-off event, it could signal improving sentiment toward Japan's manufacturing sector and the global demand outlook more broadly. That would be a modest positive for the indices. On the FX side, a single stock move doesn't have much direct impact, but if this reflects a broader risk on tone or renewed growth expectations, that could weaken the yen slightly as investors move into riskier assets.
And yields?
Minimal immediate impact from a single stock rally. You'd need to see this kind of momentum spread across multiple sectors and signal a broader economic acceleration before it starts to influence JGB yield dynamics. So I'd say this is more of an equity story than a rate story at this stage.
Shifting back to the big picture, we've covered a lot of ground today despite the market being closed. We have oil prices pulling back on diplomatic hopes, a major geopolitical shock erasing trillions in global market cap, and a notable corporate move in Sumitomo Rubber. How should global investors be positioning as we head into next week?
I think the key takeaway is that we're in a period of heightened uncertainty, particularly around geopolitics and energy. For Japan specifically, the interplay between lower oil prices and geopolitical risk is complex. Lower energy costs are structurally positive for Japan's economy, but if the geopolitical situation escalates, that benefit gets swamped by risk-off dynamics, yen strength, and weaker global demand. Investors need to watch the news flow closely, especially any updates on the Iran situation and U.S. diplomatic efforts. On the equity side, I'd be cautious on export-heavy names in the near term and more constructive on domestic consumer and utility sectors that benefit from lower energy costs. On the yen, expect volatility, and on yields, the bias is probably lower as risk aversion dominates.
That's a very clear framework. And just to emphasize, none of this is financial advice. We're here to provide context and help global investors understand the Japan market landscape. If you're tracking Japanese equities, FX, or rates, consider subscribing to TOI Japan Market Radio for daily updates. Thanks again for joining us today.
Thanks for having me. Looking forward to next week's session.
That's it for today's briefing. We'll be back with you next time the market is open. Stay informed, stay disciplined, and we'll talk soon.